welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital. And today's episode is all about what VCs and angels and founders think about Y-Combinator, which is, of course, the most prestigious and important accelerator in the entire world. So super fun. We have a VC with us, a good friend, Gabriel Jarrosson, who's the general partner of Lobster Capital. And actually, they kind of focus on YC, so we'll get into that in a second. But couldn't have a better person on to talk about this than you, Gabriel. So thank you so much for being here. And before we dig in, why don't you give a quick intro?
Thank you so much for having me. I'm excited to be having this conversation. Always happy to talk about YC, obviously. So I'm the GP of Lobster Capital. We're a YC-only fund. We're aiming, and I almost want to say trying and succeeding to invest in the top 2% of startups that come out of Y-Combinator. So we're very selective on top of YC. Just a brief overview, my background before that is as an operator and founder. I've built 7 startups and sold 3. Not that those exits were massive, but I've been in the founder's seat, and then an investor for many years as an angel, as a syndicate lead, and that's what led me to starting Lobster Capital in 2023.
Cool. Well, like I said, thanks for being here.
Thank you.
We're kind of going to go all over the place in this, but I just think Y Combinator is such a special thing that not everyone in venture has been invited to or been able to attend, and it's really cool. And I think I really want to share with our audience everything about it, and it's evolved, of course, over time. So like now, maybe we start there. I wasn't at the Y Combinator, the recent September, was it September 9th, the last one?
Yes, we missed you there.
Yeah, so you missed me. Someone else from my team was there. We were at the one before that, and before that, I think it was remote during COVID, and then it was in person before that. So like it's been a bit of a journey. But anyway, I'm curious your take on it now, like having been involved in it since, I don't know, how long have you been going to Y Combinator?
2020, actually, my first demo day when it was remote. I was trying to get in for a few years or for a few months. But so yeah, I mean, YC has evolved a lot in the last 5 years. Major changes. So it went full remote during COVID as a demo day, but also the program itself. After COVID was sort of over, 2022, 2023, and again, depending on what you call over for COVID, but the demo day stayed online, even if the program was back in person. Their idea probably was, anyone can attend from anywhere around the world. Finally, they brought demo day back in person, but really after a while, I think it was 2024 or something. And so that's a big change. They also moved from 2 batches a year to 4 batches a year, which is also quite a substantial change. The batches are slightly smaller, but there's twice as many. So every quarter, it used to be winter and summer, and so demo days would be September and March. And so they added spring and fall, and so they added demo days in June and December. So now it's every 3 months. There's also a change at the head of YC, new CEO. It's been less than 3 years, Gary Tan. Before it was Geoff Ralston, and he was there for several years as well, and during COVID. And that's the biggest changes I would say that have happened recently. What else can I think of? Back to deep tech, I would say. It used to be just B2B SaaS, the AI factory. It's heavily leaning towards AI, of course, but they do deep tech and defense and stuff like that as well. Yeah, many things going on. It's still evolving.
The only other thing I would think that at least I kind of picked up on is that there was a while there where it got very international, and it was looking at startups in like every country all over the world.
Yes.
And I think they kind of pulled back from that and went back to being more local, right? Is that still the case?
I forgot about that, but thank God you're here. Yes, yes. They sort of, I guess, piggybacked on the COVID thing and being remote to say, hey, we're going to bring startups from mostly were Indian startups, Latin American startups, and Mexican mostly. A little bit in Africa, mostly in Nigeria, but honestly everywhere. There are startups in Germany and Vietnam and whatnot. Yes, now you have to be in person in San Francisco for the program, and your startup has to be for the US market. It has to be local. You're absolutely right.
Yeah, cool. That makes sense. And so you've been going to it pretty much around the same time as me. I didn't go to every single Y Combinator since 2019. I think is the first one I went to, but every year I went to one and kind of like saw this evolution too, but I'm by no means an expert in it. We also, I'll take a step back and just share with our audience, we've invested in several YC companies, like K Street, myself personally in K Street. And although that's not our thesis, like Lobster, obviously it's completely different. But what we found is that sometimes they were totally hit or miss. Like the company might go bust like 6 months after we made the investment, or it never went anywhere. It wasn't as great as we thought it was. Or sometimes we made an investment and it did really super well and was incredible. And I think, trying to figure out like which because how many companies is it in a cohort?
It's around 120, 150 now, 4 times a year. So it's
4 times a year.
Around 500 a year.
Yeah, like 500 companies a year. Which ones are you going to choose to invest in?
Yeah.
It's pretty challenging. So I want to get into that with you. But I think that for a while I was very turned off by Y-Combinator because we had so many that didn't seem like they did that well. And when you go to Y-Combinator, you don't really get to do your own diligence. You're kind of just like, you have to write your check like that day basically, or like pretty quickly thereafter. And you don't really get to spend a whole lot of time with the founder. And so you're kind of just like going off your gut, which is a very different investment strategy than, a lot of other funds have. So anyway, maybe dig in a little bit on your strategy at Lobster and how you guys think about it and how you pick deals.
Yeah, I mean, you're right. I see that a lot as well, where YC is a forcing function for founders to, for 3 months to build, but it's also a forcing function for investors. Just like you said, for people who don't know, but many people actually, I think, do know that because they've heard about it. You have to invest very quickly. Usually, sometimes that day, almost on the spot, if you want to have an allocation, because those deals fill very, very fast. And so if you're used to, 2 weeks or a month of due diligence, of course, you can do that here. One thing that I think surprises people is, some YC companies fail. And, YC never says, we're infallible and all of the companies are going to succeed. There's still, I think, around 50% of the companies that go to zero in less than 2 years in YC, which is, I guess, the normal rate or somewhere around that. What's interesting with YC is the level of success for the ones that survive. And so they have a very famous 6.5% unicorn rate. It's actually probably going higher now, but we're going to need few years to know for sure, but it looks like it's going slightly higher. And what's interesting as well is 1 in 4 of their unicorns actually ends up becoming a decacorn, 10 billion plus, which for us fund managers, of course, a unicorn is already amazing, but a decacorn in terms of returns for your fund is just completely amazing. So that's what you got to focus on. But yeah, some people come and they invest in like 1 or 2 YC company and the company fails and they're like, YC sucks. Of course, if you don't have portfolio construction, it can't work. Now, that being said, I mean, what you touched on, I think, is very interesting. It's mostly almost an instinct, a gut feeling. I like this founder. That's how 99% of people invest in YC. At Lobster Capital, because it's our bread and butter, and we do this, the whole year. We try to do it slightly differently. And when I said in the introduction, we aim to invest in the top 2% of YC startups. Well, what's the top 2%? It's our own definition, but mostly it's the top 2% of teams, and we're, again, not based on feelings, but where we can really measure it, repeat entrepreneurs, founders who come from Stanford, MIT, or from Google or SpaceX or whatever, and top 2% in terms of early traction. So we've developed this method that, I should say we've developed this this opinion that if a company during YC is able to generate meaningful early traction in the hundreds of thousands of dollars or in the millions, it's a reflection on the team and how good they are at executing. It's a reflection on product market fit. Basically the whole idea is you don't get to 1 million in a couple months by chance. Like, it's extremely difficult to do. Most startups, YC or not, don't do it that quickly. So if you have done it that quickly, clearly you're doing a lot of things right. And so that's how we're able to sort of combine the speed that's needed or required with the conviction that we need. And of course, it opens a whole set of new other problems, which is, how do you find them? How do you get allocation in them? Yeah. That was your question. Okay,
that was going to be my next question. I know we've talked about it, but I think it'd be interesting for other people to hear. How do you find them? How do you get into them? I kind of know, but getting into them is tough, right?
I'll tell you for us specifically, but it's, that's the name of the game. If you're able to find a sort of repeatable way of finding the best YC companies and investing in them, you're going to be very happy. You're going to do very, very well. And that's what we're building, because we want to do very, very well, obviously. So finding them, I guess it helps. So we have a lot of network. We know everyone in YC could be doing this for many years. If you're a newbie and you want to find them, the only thing I can say is it helps that we're only focused on YC. I see so many funds who do their funds and YC as well, which it's a good thing to be looking at YC, but of course, when you're running your fund and then there's 500 companies a year, that's actually a lot. And so I talked to big funds about that as well. I talked recently to a 3 billion fund, and they said, how could we do it? And I said, if you really want to be serious about it, you should hire 5 people and tell them the 5 of you are full-time YC, and just look at everything, talk to everyone, etc. So that's that for us. That's honestly one of the solutions. Is just, hey, we're only doing this. We also have a lot of we've built a lot of tools internally to be able to detect companies that have signals of, oh, it seems to be going really well there, so we should be going out and talk to them. And then how do you secure allocation? Again, very, very big topic. Something to note here, probably again, most investors know, but for those who don't, YC has an internal rating tool about investors called Bookface. And so every time you invest in any YC company, they're going to give you a rating. It's pretty much like an Airbnb. When you leave, you give a 5-star rating. And so they're going to say, okay, Gabriel, Paige, I loved working with them. Very easy, they're very helpful, blah, blah, blah. Or, oh my God, it was a nightmare working with Gabriel. I hated it. I would not recommend it to someone else. And then when you talk to a new YC startup, they're going to go check your reviews. Is she a good
That's so
investor?
Funny. I had no idea they were doing that. That's amazing.
Oh, you didn't know?
I'm glad.
Okay.
Yeah.
Wow. Well, yeah. So Bookface. Yeah. So it's interesting because everything you do with them is sort of rated, is sort of kept. So yeah, you have to be on your base behavior, ideally. It's a forcing function again. And so that's one thing. You got to have sort of a good reputation overall. For us specifically, we're bringing 2 things to the startups that really allows us to get into the bed deal every single time. One is my experience as a founder with exits, that I'm just telling them, hey, I've been in your shoes. I know exactly what you need to grow. I'll help you there, and that's always appreciated. The other thing that's even bigger now is we have a very, very big online platform, online voice, mostly on social media. So that's our LinkedIn, our Twitter, our YouTube, our podcast, our newsletter. Like we've built we get more than 1 million views per month in all of that. So that's something I share with them. I can say, hey, I can promote your startup here, give it visibility. You can come under the umbrella of the network, and I can help you get distribution and customers. And so that's a very unique thing that they don't get with most other investors. So that's one of the reasons that we're able to get into a lot of deals.
Cool. Yeah, I think that makes a ton of sense, and I think it's a great strategy, and I think that only someone uniquely positioned to be able to do that like you, who's been in it for such a long time, could really, I think, do well in and really execute on them. Plus, I'm sure you kind of start to find out, all the founders know each other, right? Some of the best deals we've ever gotten into were founders we invested in who then brought in another company that was raising, and then we invested in that company. And so all the YC companies talk to each other. Any of the ones you've invested to, I'm sure they're like, hey, you should look at this one, right? They know.
It's a very tight community. We've made more than 100 investments now in YC. So yes, everyone knows each other. And again, your reputation. It's hey, you should really talk to K Street. You should really talk to Lobster because they've been great. So your reputation just compounds.
Yeah. So I think your whole strategy is much, much smarter than mine. And that's probably why we haven't made a whole lot of as many YC investments. But I mean, it was our journey was similar. Not similar, I should say. Our journey was different because first it was trying to figure out how to get into the event in the first place. And that was really tough, which is the next topic I want to talk about. Finally, you get in, then COVID happens. There were a lot of changes, then more changes. And then trying to pick the winners, everything you just said, it's very hard if that's not your primary strategy. It's almost impossible. And so we had a lot of not wins, and Y-Combinator is still the best in the world, right? Hands down. So I'm not, picking those best companies if you're doing it in the strategy that you're using, I think it's incredible. It makes a ton of sense. And that's a great strategy. For us, I don't think our strategy was that great. So now we then we ran into this issue where the best deals that we wanted to get into that had that early traction and all the things you just pointed out, they were already oversubscribed before the day anyway.
By people like me. Yeah, sorry.
For people like you. Yeah, thanks a lot.
It's super interesting. So by the way, I love this strategy. Obviously, I made it my full-time job. I agree with you. I think it makes a lot of sense. I want to say, there are amazing deals outside of YC in Silicon Valley and in the world probably. So, because of the position that I'm in, I get so many fund managers come to me, honestly, at least one every week. Oh, how can I get into YC? If I don't get into YC, my fund is dead. And that's what I tell them, YC is great. Don't let me say otherwise, but you can probably get other deals outside of YC. And we'll get into how to get into YC in a minute. So for maybe all of those managers, I can say, go listen to the podcast. That being said, yes, it is a big problem. I just sent a deal to a friend of mine that has a fund here. And he told me I've stopped completely investing in YC startups because I'm not an insider. And so there's the problem of adverse selection. If I see the deal now, it means thousands of people have said no at demo day, thousands of other investors who do this, full time. Yes. And so the only deals that reach me are sort of the bad deals. And that's one of the reasons sometimes that YC gets a bad rap is people see probably the worst deals because they're not doing YC full time. If you really do YC full time, you see amazing deals, but they get really oversubscribed in a couple of days, sometimes in one day. It's pretty crazy.
Yeah. We've totally witnessed that, and had founders tell us that they could maybe write us a tiny like 50K allocation if we could wire like within 24 hours type thing. Right.
That's what it is.
So,
crazy. It's interesting. YC flips everything on its head. It's not it's not startups chasing investors, which is what it is in the rest of the world. It's investors chasing startups. It's really kind of crazy. And I think you touched on that. Money becomes almost irrelevant for them. After YC, most companies raise between 2 and 5 million, mostly 2, 3, $4 million rounds, but they often get offered up to 15, 20, 25 million. So they can literally pick and choose. So that's where, again, your reputation, your network, and your rating has a lot of importance.
Yeah, exactly. Totally makes sense. And let's talk a little bit about how you can get into YC. And we're just so to make sure everyone understands, we're talking about how do you get into the event, like how do you attend the event, get invited to the event, because it is a closed event. You can't just appear there, and you're going to miss out on all of the things we're talking about if you can't actually get into that event. So I'm very curious about what you're going to say, Gabriel, because I only know how I got in. I don't know how everybody else does it.
Well, I'm curious how you got in. Maybe you want to start with this, or no? Okay, I'll start.
No, you go first. Okay, it's probably common, but yeah.
So it's 4 times a year. It's in person in San Francisco, in the YC office now, in the Dog Patch. They also tried running it in other places, but I think now they're very happy and comfortable running it in their place of business in the Dog Patch in San Francisco. It actually almost runs out of like it's almost always at capacity. So even if you're on the list, I know some people who are not able to get in. So that's another thing is you should come in. Like sometimes people show up at 10 a.m. and that's it, you can get in. Also once, but now they're trying to solve it. But I think it was 2 or 3 demo days ago. Then when you're inside the building, the pitches happen on the first floor. And everyone, you have the floor below and the floor above, and you can just talk to founders, but the pitches are there. But that floor as well was at capacity. So even inside the building, there was a queue to go listen to the pitches. So that's pretty crazy, right? And so now they're trying to solve it in this demo day in September. They gave everyone headsets like this one. And so you could be on another floor and listen to the pitch anyway. And so to answer now the main question, everyone's like, oh, it's going on a tangent, but how do we get in? I want to know. So YC doesn't officially, I'm trying to do some theatrics for the show, right? YC is not specifically revealing who they invite and who they don't invite. So it's basically check your inbox. And if you're doing some stuff in the YC community, you might get an invite. But still, they did say something semi-publicly last year. And when I say semi-publicly, it's not, I guess, on their website or on their YouTube channel, but they did, I guess, send an email to thousands of investors about that. So, I'm not revealing a big secret here. Basically, they said the way to be invited is to already have been investing in a YC company recently. And so there's a time element. If it's 5 years ago, it doesn't work. I think it's probably in the last year, if I remember correctly. And then there's a minimum that you have to have invested, which if you invest like 2K or 5K in a deal, you're not getting invited. But the minimum is pretty low. If I remember correctly, it's 50K. And so if I'm piecing this together from memory, it's if you've invested at least 50K in at least one YC startup in the last year, then you can probably get invited. And if you're not, you can probably reach out to someone at YC and say, hey, I've invested 50K in a YC company recently. I want to come, and they probably would invite you. Again, that was the rule last year. What I see now is more and more people are trying to get in. And so maybe this number goes up. Maybe it's 100K, 150K. Maybe it's in the last 6 months, not in the last year. But what I do know is if you go to demo day and then don't write checks, then they stop inviting you. That's the whole thing. So it's a sort of a nice way for them to sort of invite you to keep writing checks into YC startup.
Exactly. So I think that's I've never heard any of those things, but I know that I got it in a similar way. Like I was trying, wouldn't let me. Then I invested in like 2 YC companies and then tried again. And then suddenly I got it. And I was like, oh my God, it's a miracle. Like, how did this happen? I don't know. Yeah. That's probably why. And then we did continue to invest in YC companies after that. Not every year though, but like to your point, maybe it's getting more every year. It's getting tighter, and so maybe we need to. Like I don't think we invested in the past 12 months, but we're still invited right now. But maybe that's going to change. But I guess
it also depends on the size of the fund. If you're a very small angel, it's easier to drop you than if you're an established fund, for example. The check size overall.
Yeah.
So yeah, and then people might be wondering, but how do you invest in some YC sharps then if you're not at demo day? And honestly, do what you can. And again, there's the adverse selection. Like probably those first investments are maybe not the best of the YC batch. That being said, it's very interesting. That's how I got started. I was an outsider, and I would honestly get the scraps of what no one else had invested into, exactly like people do today. But sometimes you can be right against the crowd. So sometimes a deal gets overlooked. It actually does well. So, in 2020, we did, I think, 10 YC investments, and 2 of those became breakout success. And so that's also established our reputation inside YC, but also, I guess no one wanted them at demo day, but still we were able to invest in them. So, it's both true and not true. The adverse selection thing, it might be the case or it might not.
Yeah, but if you really want to get into YC, that you could just do that, because I wasn't in YC. I invested in probably the adverse selection companies maybe, but one of them actually did pretty well, and we didn't get into it through YC. Exactly. So like, I think if you do that, if you're willing to really commit to making some investments in some YC companies, you will eventually probably get invited. You just have to actually participate. The whole point of the event is for these companies to close their rounds quickly so that they can go execute, right? So I think that's really
YC need investors, so that's true. So they need us as well. So we need them probably, but it's an ecosystem. They need us as well.
So I want to tell you what my current strategy is, and then I want you to pick it all apart publicly in front of all of my audience.
Okay. Ooh, that's dangerous. I love it.
So right now, what we're thinking we're going to do for YC is we're going to keep going, but we're going to try to spend more time. Look, because I think they release the deals, the companies that are going to be presenting like a couple days beforehand. So, but it's so many companies, it's like impossible for you to do deep dives on like 150 companies in 2 days. But we're going to go through them and try to like sort through what, just based on our thesis, like what are the top 25 that we like, and then really pay attention to those 25 on demo day. Maybe even reach out to them ahead of time to tell them that we're looking at them for investment, so that we're like a little bit ahead of a lot of the other people, and then see them on demo day, and then be ready on that day to write like 2 or 3 checks, smaller checks than we normally write. Like our normal check size is like 300, 500K, maybe more. But this is just like a way to continue participating in YC because we believe in it. Write 2 or 3 25K checks, maybe, whatever, see what happens, and just keep doing that every year. That's our current so there you go. Pick it apart, destroy it.
I mean, again, like that. Thank you for doing this sort of dangerous game. I think lots of things make sense in the strategy. So, like you said, it's a problem of sorting first. There's too many. But probably you're right. Out of those 150, 25 are really interesting. So that's going to be tough going from 150 to 25 in a few days. Like that's the I would put a question mark there.
Full team effort, by the way, not just like one.
Okay, yeah, exactly. Like if you have to throw lots of resources to this, but yeah, okay, add this. So that works. Then emailing them ahead of time. That's probably doesn't hurt if you find the email addresses. Be like, hey, we're looking at you. We'll be at demo day. Happy to see you there. Why not? Probably works. And then paying attention at demo day, and then so. Couple question marks that I'm throwing back at you is how do you go from 25 to 3? That's not easy in a single day.
25. Right? We narrow it down to the 3. That's a great. I mean, that's a very good question, and I don't know the answer to that yet.
It's not easy for you. Like you're there, and you're like, okay, I got to pick 3. That's tough. So here, I would say either don't do 3, but do like 10, and then going from 25 to 10 is pretty easy because some of them you won't like. And many you'll be like, well, okay, why not? And then the bar is just that, okay, why not? You give them 25K. So that would be my first thing. But if you're going to go from 25 to 3, it's possible. But I would sort of have a strategy ahead of time, not show up at the way and be like, oh, I'm going to have 3 investments because then so really say this is how we're going to pick the 3. So that's my first thing. If you do 10, let me just ask you, if you do 10, sure. How big of a check do you need to write for it to be meaningful for that founder? Will they even bother with you, right? So that's my other point. Regardless of 10 or 3, a 25K check is not very meaningful for them, but it's also not very meaningful for you. So the fact that it's not meaningful for them can sometimes work in your favor because they're thinking allocation. They're thinking we raising 2 million, but we have too much demand. They have people like me who write 500K checks to try to fit.
Right.
And so sometimes, like a good friend of mine, the deal was massively oversubscribed. That's 10 days ago at demo day. The deal, like no one could get in, and then he was like, "Oh, I got in." And I'm like, how did you do it? That's pretty cool. And he said, well, I wrote a 2K check.
Oh, there you go.
And so, it doesn't make any difference for them. A 2K check is nothing. So
interesting. What do you think is the threshold, like the dollar amount threshold that's meaningless, like that or under?
I mean, 25. So, but it's not only great. So let me, because it's so, but yeah, 25 is really on the lower bracket. I've heard companies, they can accept, the story here is 2K. Not every company will accept you at 2K, but some of them will accept 10. I guess most of them probably would accept 10. So, that's and again, it doesn't fill their round, even 25. But now I think it's a problem for you though. Like, of course you can get in and give away 10K checks like it's M&Ms, but it's a problem for you because you as a fund manager and anyone who's investing, unless you're just an angel sort of having fun, then, go have fun, go have your fun, write your 10K, 25K check. But even as an angel, actually, you should think of portfolio construction. But as a fund, you have to think of portfolio construction. So you get into 3 deals, you get into 10 deals, whatever the amount, they're all at 25K, where all of your other deals are at 300, 400, 500K. Now you're in YC because you believe in the performance. You believe YC companies do great. And so one of those startups explodes, becomes a unicorn. It's awesome. But you wrote a tiny check, which if your fund has, how many portfolio companies do you have? 20, 30, 50?
25, yeah.
25?
25.
And so that instead of being 1/25th of the fund, because it's divided by 10, it's 1/250th of the fund.
Yeah, I think I'm thinking about it like I totally agree with you, and I haven't really thought this out fully in full transparency, but this is just our current draft strategy.
That's why I'm here.
I think like the thought is we're really more like late seed A investors anyway. And so maybe if we're taking a tiny, tiny little sliver of our portfolio just to get in and get to know these companies over time, right? Of the 10, maybe, well, I was thinking 3, but let's just say it's 10. That's probably good advice. Maybe like 2 of them are more interesting in their next round and we get to know them and support them in the meantime. And then we have an allocation in that next round, which is really the round we would probably be most interested in anyway, realistically. So that's
so that makes perfect sense. Yeah.
Yeah, that's the thinking.
That makes perfect sense. In that case, I would say, again, sorry, you asked me to poke the hole, so I will poke the hole.
Do it. I would never be as good as your strategy. There's no way. It's not
Come
possible.
on, you're killing it. Everyone knows you're killing it. It's a different strategy. We'll see in 15 years what the results are. I obviously believe very strongly in Lobster, but I don't think Lobster will be the only fund in the world to perform. Yeah. So you're killing it. But
I think for a strategy around YC, yours is unbeatable. Yeah. Right.
Thank you. For those companies. Can you come and say this to all of my LPs, please?
I know. Seriously, invite me. Next time I'm there, we'll have a chat.
So first of all, you should probably then call it what it is, which is a scout program. You should say, hey, we have a YC scout program. And again, this allows you to sort of almost have a dedicated team. I don't know if it's a full-time team, but it's just like, hey, team, this is the YC week. We're entering the YC scout program mode or something, and we're going to do that. Then if it's a scout program, it makes sense to have more than 3, for sure. Like, I think you already agreed to that because you want to sort of see several companies. The big issue now that I see, so I think this makes more sense than the first version, but the big issue that I see is for small checks like 25K, you almost never will get pro rata out of them because they're trained to only give pro rata to big checks. Yeah. Like, I'll give you an example. My first YC fund, Lobster Capital, I was writing 250K checks. And even then, sometimes they would tell me, 250 for pro rata, we reserve it for bigger checks. And so because it was mandatory for me, so I pushed on it and I usually got it. But for 25, I'm not sure. And so then when it's a Series A, if it's a good Series A, if it's a great company, it's led by a tier 1, then you're priced out of your pro rata and you can't follow on. And that's, again, a big problem.
It's a good point because you're right. Even if you write a 25K check and you have pro rata, that pro rata is not going to be big enough for my fund's check size. Anyway. Exactly.
Even if you get it, that's true.
Even if you get it. Yeah. So I think the only thing you can lean on in that scenario is if you got to know the company and helped them materially and they really valued you as an investor, as a strategic for whatever reason.
You got to make sure you do that. Because again, if it's a tier 1 leading the Series A, everyone wants to double, triple down. Like I've seen that happen. We're lucky in that way, but it gets crazy once you get a big name coming in. There's no room for anyone. So yeah, you got to make sure you have. But if you do that, then that's a very solid strategy.
I don't know that we would be successful at this, and it's still evolving in my mind how we would do it. But we've just been participants in YC for so long, and we've still been like trying to evolve what we think our strategy should be as the program itself has evolved too, right? Like we can't be at every demo day of the year, all 4 of them. There's no way. We're not in the Bay Area, so it's just like it's a big lift. And to your point, actually, this is one of the other things I wanted you talked about that I wanted to point out, like from going two YCs ago, whatever that was, like April maybe, whatever that one was.
Mm-hmm. Yeah.
that it's even if you're there, you're not in the room. Like it's not like you can hear all these pitches easily. You're not able to see all of the companies, even if you're in the event, even if you get into the event and you actually go to it and you get in before the line is too big. It's still really tough. So I think people don't realize that if they've never been before, that's really, it's gotten kind of crazy.
The pitches, they start around 9:30 a.m. and then there's going to be several breaks, including a lunch break, but the entire pitch are going to end around 3 to 4 p.m. So again, yeah, like you said, even if you're there, even if you're committed to it, it's extremely tiring, it's extremely difficult to pay attention, and it's 1 minute pitch.
Yeah.
It's so easy to get a text. It happened to me the first few times. I'm like, oh, I already know this company, so let me open up an email. And then it's like the next pitch, you're like, oh my God,
I didn't hear the beginning of it. Yeah.
And that's it. They're gone. They're off stage. Yeah. That's it. So yeah, you gotta super focus, pay attention. It's not easy. It's crazy exhausting day. Yeah, I think it's interesting. Every demo day now for the last year, so the last 4 demo days probably, I met other funds similar to yours in a way, similar to yours in the fact that they're not specializing in YC, but several times, I'm not kidding you, several times funds told me, we're changing our strategy. We need to do YC. We didn't do it before, but we need to do it because we're missing out on the best deals. Someone told me, my LPs don't want me to do YC, but I'm still doing it sort of low key. And I was like, how do you do it if your LPs don't want you to do it? And he said, I'll tell them in several years when we have the returns, and they'll be like, okay, that's fine. So like literally people are almost lying to their LPs. So,
interesting.
It's crazy. And maybe that's why people hate on YC so much. It's because it's impossible to avoid in a way. And in a way that makes people uncomfortable. That's why, I feel very good about it.
Oh, I was just saying it. You can't beat the track record. It's the best,
Yeah, exactly. But it's tough. Yeah, if you're not doing it, really, if you're not putting, I guess that, the summary of everything we talked about, and that's what you're doing as well, is if you want to participate in YC, you should at least throw some serious effort behind it. That's what you're doing. And so, you have a pretty lean strategy that's probably going to work out. But people who do it casually, it's tough.
It's kind of pointless. Yeah, like the other thing I'll say, and then I want to move on to my favorite 3 questions that I ask everybody. I think you know what they are, maybe. The last thing I want to say is that it's a great event because of the people that you meet when you're there, regardless, and because of what you learn about just what's happening in tech right now. That's like, where are the trends? You very quickly get a very clear view of what are the things people are building in right now, what's unique, what's not, what's being done a lot of different times, and more broad trends about the early stage venture space. And I think that's part of why I love it, but I know that you can't just go, it's not the kind of thing you can just go to and watch and observe. You have to participate and you have to have a strategy. So yeah.
Yeah, it would be great if anyone could just come and see the trends. That's another thing, and I'm wondering as well, like, what's YC's strategy going to be? I think recently, what I've observed is they're slowly, a little bit trying to open it a little bit more. Maybe at some point it's live on YouTube and everyone can watch. Who knows? I don't know. But yeah, it is the tip of the spear in terms of the latest trends. You go to these events as well to know where tech is going. YC has been honestly pretty visionary as an organization to where the latest tech trends are taking us. For people who don't know, OpenAI was started at YC, so that's something that's very that's not well known. But Sam Altman was YC CEO. He went through YC and then he became YC CEO.
No way, I didn't know that.
Yeah, exactly. For like I don't know, 4 years or something, for a while. And he stepped down because he wanted to run OpenAI, but OpenAI the first name was called YC Research. It was inside YC, and at the time, Paul Buchheit, who's the founder of Gmail, was left Google to come work at YC as a partner, and they were afraid that it was DeepMind, all of the AI was concentrated at Google, and so they started this as some sort of a counterpower, if you want, of countering Google, making sure all the AI is not in Google's hands, and that's why it was supposed to be open source. That's why it's called OpenAI. Of course, now people jokingly call it closed AI because it's not open source anymore. But and then when it really became bigger and bigger, it actually spun out of YC, but it was started at YC. And so Sam Altman is very, very close to the YC ecosystem. He comes back. Most of the batches actually talk to the founders. You're 19-year-old, you make it to YC. first week you meet Sam Altman. It's pretty cool.
Cool.
And then you get to meet Brian Chesky from Airbnb and the Collison brothers from Stripe, etc., which they all come back and tell you about their journey. You get to meet Paul Graham, who's very often, almost every time or every batch there as well. And so some YC companies have access to OpenAI models that are not released to the public. Like, right now we're taping this, we're at GPT-5, but some YC companies are building on GPT-6, and they're the only ones in the world having access to that, because again, they've stayed very close to the YC ecosystem. So that's pretty cool, and that's also what's attracting some of the best AI founders to come and build at YC. You get more than $1 million of free cloud credits. That's substantial. I think it's one of the biggest amount, $1 million of free cloud. Also, you get to build on the latest OpenAI model that no one else has. It's pretty compelling.
Yeah, it's pretty compelling. There's a lot of benefits, and getting to meet all of those founders, from unicorn level companies that have done, and decacorn level that have done this before. It's
centicorns, I guess, because Airbnb is 100 billion. So
yeah, right, exactly.
You just hang out with Sam Altman and Brian Chesky. It's pretty exceptional. Yeah.
Yeah. Well, cool. Well, okay, I'm going to ask you my 3 questions. The first one, I feel like I shouldn't even ask you because it's what is the most interesting inside baseball thing that you've learned about VC, and I feel like you told us so many things already that would qualify for the answer. But what would you say coming into venture? Really, it's for people that are not working in venture every day, or they've never raised money in the venture world. And if you were in it, like once you got in it, like what do you think was the most unusual or surprising thing that you learned?
I mean, it's interesting because. So I do a lot of podcasts, I have my own, etc. And so I glanced over the questions briefly, but I usually don't like to prepare. So I just glanced at them and was like, that's fine. But then this one, I was like, what should I answer there? And then so I kept thinking for 5 minutes, and the answer that I came up with, it's not a very good answer for the industry, but is I've been investing for 13 years now. So also it's been quite a while, but I've been pretty surprised at how sort of amateurish most big investors are. And by that I mean investing today still relies a lot on vibes and feelings and I like him, I like her. And so big funds, like people who've raised and deployed hundreds of millions of dollars, sometimes billions. And so you'd think like those guys appear so serious. You're like, oh my God, they run a big firm. And people that I see at YC as well. And then you're asking, why did you invest? And they're like, it was maybe it's a YC thing because again, you have to invest quickly. So maybe it's a
I think it's I don't think it's just YC, but yeah.
So very surprising to me.
Like we've had companies tell us that our diligence was the most serious diligence of any of the funds they have, and we're the smallest fund in their deal. They've got huge funds, huge institutional funds, and our diligence isn't even that much either. We're a small fund, right? So it's just okay. So what's your biggest failure, and what did you learn from it?
So many of them. What to choose from? I mean, there are 2 very, very big failures. So I'll get to the 2 of them very quickly. One is a company that I said no to their pre-seed round, and it ended up becoming a $9 billion company. And I just said no. And so obviously, it kind of hurts. I had allocation for 150K, and it would have returned over $200 million. Yeah. And so in 4 years or 5 years, like in a short amount of time too. So by the way, that company has not exited. It's not liquid, so maybe I would still be in it, or I could have sold some SAC entries. But anyway, so that hurts. I did a big sort of post-mortem of why did I say no? What did I miss, etc. Very interestingly, my conclusion, even after the fact, is it was in theory the good call to say no. Obviously, it wasn't, because if I had said yes, I would. But again, I'm trying to have a very specific approach. I'm trying to have very tight investment criteria and very disciplined about it. And so I took the right decision at the time with the very limited set of information that I had at the time. And so, in a case like this, it's very tempting to change everything and sort of chase the trend. But I said to myself, that's probably a mistake over the long run. So let me just keep my system in place. I put it into question, like, should I change the system?
Yeah.
I looked at it very, very carefully, but the conclusion was, I shouldn't change the system. And I always tell my investors and my LPs, my system is not a catch-all. It's not a crystal ball. And no one's system is. You can't predict the future. My idea is just to increase my odds overall, but it's not going to catch everything. So that's a very big failure. A second one that's probably even bigger is a YC company. This one was not a YC company, but this is a YC company that we invested at the seed and in 2020 or 2021. And the company just exploded in growth. And so they raised a seed extension. And so we reinvested. That was before the fund, by the way. The fund we're And that's one of the reasons we invest a single check and same size every time. And so we're very disciplined. But this was with Angel Syndicate. So I ran a first syndicate, then a second one. Then they did it. They kept growing. Did a Series A, we invested. Then they did a Series B, they invested. And so over, I think, 5 rounds, we ended up investing, I think, 4.5 million into the company, which by far was our most substantial investment. But the company went from a 12 million valuation to a 500 million valuation. The numbers were here, the growth was insane. So we were just sort of riding the wave. Everyone was happy. And of course, something that I didn't see at the time is that they were burning. So the company in total, I think, raised more than 50 million, but they ended up burning at some point, I think, $4 million a month. Yeah. And that was 2021, 2022. As long as you were growing, no one cared about the burn. It's crazy. At the time, no one cared about the burn. And of course, end of 22, early 23, the music stopped. And so they needed to raise more and more and more to sort of feed the beast, but the money stopped coming. And so they actually had a term sheet signed for 25 million, but the money never came because the fund called money from the LPs. The LPs never send the money to the fund, so the fund never sent the money to the startup. And so in like 2 weeks, the company was insolvent, couldn't pay its employees, couldn't pay it wasn't a fintech, so they couldn't pay their banking partners. And so overnight, everything crumbled. And so, I mean, the company technically is still alive. It was sort of saved, but it's a zombie company now. They pivoted, the founder left. So basically it's all gone. Like, again, the company's still here, but the money's gone. It's unlikely we'll see anything from that. So that's the biggest mistake. Not caring about the burn, just piling money, and probably too concentrated, probably too emotional. But, everyone, including myself, are like, oh, we're going to be so rich from this. You're sort of blinded by the success we're all believing into, and just piling probably too much money into it. Very painful, honestly. Also, very valuable lesson, right, for the future. Oh, yeah. But very painful, very costly lesson as well.
Yeah, I think that's a really key thing, because it's not bad to keep your pro rata over time and keep investing as long as the company is still doing well. But it's tough to evaluate that sometimes when you're a small investor and they're not giving you all the information and you don't have rights to it anymore, and you're just trying to assess, what to do. So
and still raising on safes at 500 million valuation as well.
Oh wow.
It was another time. 2021, 2022 was crazy.
I guess you're right. Yeah, I guess it was crazy. It was that time. Okay, last question. What's the best advice you've ever received?
One that really stuck with me, I got it my first month of being an entrepreneur when I was 18. So, I had hair many years back. And someone told me, I was building a business and I had this sort of vision and business plan or whatever. And my dad introduced me to my dad was not an entrepreneur, but he introduced me to his entrepreneur friend. So, guy who's probably 55, built businesses his whole life. And like, oh, I want to build this and this and that, and this is what I'm going to do. And I guess I presented him with sort of a marketing plan or whatever, I don't remember, but probably it involved spending a couple hundreds of thousands of dollars that of course I didn't have. And so he told me this advice that had stuck with me for so long. He said, you should plan your business as if you didn't have any money at all. And then he paused and he said, by the way, that's the case. You don't have any money at all, right? You're 18. I was like, right. Oh yeah, you're right. So, I was planning my business like I was going to spend money that I didn't have. Yeah. So this really stuck with me for many reasons. And it came back to me in my life. I was very lucky that I did well with investing. And so at 29 years old, so 10 years later, I made significant money for myself, at least, more than I thought I would probably earn in my entire life. And so it obviously changed a lot of things in my life, but I was still, I guess, young and immature. And so I spent like there's no tomorrow. And by the way, I didn't spend on whatever car or Vegas trip. I just invested. So I bought real estate. I put tons of money in the stock market. Investing is my thing, right? But I still spend the money. Like it's not, once it's in real estate, you can't really access it. And I probably went too big too quickly. And bought a nice house and stuff like that. And so then I remembered this, like plan your life like you don't have any money. And the people that I respect the most are people that have the cash, but have a very simple life, a very small house. Warren Buffett lives in the same house for 40 years.
Yep.
And so I completely sort of dialed it down. Remember those wise words from more than 10 years ago at the time. And yeah, today, I don't spend anything. I don't need more cash in my life. I have a very, small
That's
so
what you
almost
want,
boring
right?
life. I mean, it's very exciting on the professional front, but like, I don't own a car. I don't have a nice place. I'm comfortable, have the minimum. But yeah, so that's stuck with me for so long through my entrepreneur's journey, through my investor's journey, through my personal financial journey. So because it's been ringing so true for so long. And then I see so many founders who come and say to me, oh, I just need to raise $1 million and it's going to unlock the growth of my company. And I tell them every single time, you should be able to grow your company without cash.
Yeah.
The investor's money is sort of the fuel to the fire or the cherry on top, but you should be able to grow regardless. So plan your life as if you didn't have cash, because you probably don't have a lot of cash. And even when you do have cash, it's better to just sort of stash it than
It's also just
spend
peace
it.
of mind. I think that no one talks about this, but when you raise money, no matter in which way, or when you suddenly come upon money, if you spend it all and you're spending it like crazy, the anxiety in your brain is like triggering up, right? Like whether you realize it or not, probably like you kind of know that you're maybe like, this isn't what you should be doing. Unless you have a business where it's just pouring the fuel on the fire and you're already doing well and you know you're doing well. You know you're
And you
crushing
can
it and it's just helping you crush it more, right?
and you can pour fuel on the fire and you don't have to like spend everything. You raise 2 million, you could probably spend 10K a month and still add value, and so still 90% of the money stays in your bank account. And something else is, the world is very good at getting you to spend more. Like it's so easy, it's almost infinite. Like there's always a bigger car, there's always a newer iPhone, and then you start flying business class, but then you get more money and you're like, I should start flying first class, and then you get more. Oh, I should start flying private jets. Like it never ends.
It never
and then
ends.
maybe I should buy the jet instead of renting it. Like, where does it stop?
There you
Like
go.
you're gonna spend $50 million on a jet, really? So there's always something fancier, but it's kind of cliche or obvious, whatever. But happiness doesn't come from that. This sentence that I love is, you could be a millionaire or a billionaire or a gazillionaire. If your wife hates you, like money doesn't change anything, right?
Exactly.
Your wife still hates you. Or if you have terrible relationships, if you don't have any friends, or if your kids hate you, whatever. So money solves money problems, and yes, it's sometimes comfortable, obviously, but that's it. So
That's
anyway.
it. Yeah, I totally agree. Well, I can't thank you enough for taking the time to be on the show
Thank
with us.
you.
Like, I feel like you gave us so many cool secrets and just like thoughts about Y Combinator that nobody gets to hear regularly. So, yeah, like I can't thank you enough. Thank you so much, Gabriel.
Thank you for having me. It was so fun. I had a blast.
Cool. That's a wrap.